What if I told you the Euro US dollar has a dirty little secret? One that's been costing retail traders money time and time again over the past 25 years. And this isn't some wild conspiracy theory, it's data. Cold, hard, reliable data. Today, I'm going to tell you a story about the market and why buying the Euro US dollar this week in particular might not be such a great decision. Markets are often thought of as random. They're driven by news, sentiment, smart money concepts, big money, but in chaotic times, patterns emerge. Patterns that repeat themselves year after year. Patterns that we can identify. And one of my favorite patterns in the Euro US dollar pair is what I like to call the February trap. For 25 years, something fascinating has happened. The Euro US dollar pair, between the dates 3rd of February to the 8th of February, seems to lose value. In fact, it drops 68% of the time during this period. That's almost 7 out of 10 times over 2.5 decades. There's something there. So why does this happen, and more importantly, why should you care? Let's break this down with some cold, hard numbers. This here is a season X chart, and as you can see on the top left, you can see the chart where we can see the value over 25 years drops between the 3rd of February and the 8th of February. If we move over to the right hand side of your screen, you can see the winning rate is 32%, which flipped means it has a 68% losing rate. That's 17 losses and only 8 gains. Here's what it looks like in practice. These red bars, those represent the years where Euro US dollar lost value during this period. As you can see, they dominate. Now you might be asking yourself, well Jordan, isn't this just a coincidence? And there might be merit to what you're saying. If we look at something like 2008, the financial crisis obviously can skew this data to the downside. If we look at the monetary policy meeting that we saw in 2015 with the EU, once again, it moved this market during this week. But if you have a look at what's been happening recently, in particular from 2017 onwards, you'll see a level of consistency. Since 2017, only 2021 has gained positive returns on this pair between the 3rd and the 8th of February. This is the power of seasonal analysis. It shows us patterns that repeat not just because of luck, but because of deeply rooted factors like market psychology, economic cycles, and even central bank policies. Seasonality reminds us that the market has memories, and if we're smart, we can use those memories to avoid making costly mistakes, or even profit from them. So why shouldn't you buy the Euro US dollar this week? Well, you can, but historically speaking, the odds are against you. 68% of the time, it's a losing trade. It's like flipping a coin with one side heavily weighted, and you're betting on the lighter side. Trading is all about betting on probabilities. And even if this pattern doesn't play out one of the years, it's about looking at a group of data and making the right decision based on that data. Our job is to align ourselves with the highest probable outcomes. Now that doesn't mean you short it blindly either. That's where strategy and timing comes into it. I'm merely just providing you with a bit of historical data. So here's my challenge for you. Instead of following the herd or making emotional decisions, step back. Have a look at the data for yourself. Let history guide your trades. Will you let the 25-year seasonal play influence your trading this week? Or will you take the leap hoping that this year is the exception? The choice is yours. As for me, I know where my money isn't going this week. If you found this insightful, hit the like button, leave a comment in the description, even let me know if I was wrong in a week's time. Hit the subscribe button and we'll see you in the next video.